What is stock split and how does it affect your investments? How does stock split affect your investment? So here is a concise outline, you know, as it relates to how stock split affects your investment. Number one is the introduction here is what essentially is this topic all about. A stock split occurs when a company divides its existing shares into more shares, making them more affordable for investors without changing the overall value, of the company or of the investment. So number two is what is a stock split? That's a question we need to be conversant with. We should be able to answer. So in a stock split, a company issues additional shares to existing shareholders. For example, in a 2-for-1 split, shareholders receive one additional share for each share they already own. Then the total value of the investment remains the same, but the price per share decreases proportionally. The value remains the same, but the price will then decrease, in proportion to the ratio of the stock splits. Number three, how a stock split affects your investment. How a stock split affects your investment. So in this case, we consider price adjustments. Price adjustments. The share price is reduced, but the total value of your holdings stays the same. For example, if you owned, let's say, 100 shares, priced at $100 each, and for a 2-for-1 split occurs, and in the case where there's the company decides to do a 2-for-1 split, you end up with 200 shares, priced at $50 each. So in that case, there is an increased number of shares, but the value still remains the same. So there's increased liquidity. Increased liquidity. So in this case, you may observe that lower price shares can make it easier for investors to buy or sell, potentially increasing the stock's liquidity. So the lower the price, the more attractive it becomes to investors. And as investors buy and sell, there's that increase in liquidity, in transacting, on the shares. So there's no immediate impact on value. The value remains the same. So a stock split does not inherently increase or decrease the value of the company. It's simply a cosmetic change, to the number of shares outstanding. It doesn't really add or subtract anything from the value of the company. The overall value remains the same. The entire exercise is cosmetic in nature, and it's equally, psychological. Please like this video and subscribe to this channel if you've not done that. So why do companies split their stocks? Why do they split their stocks? They do it for the purpose of affordability, to make the shares more affordable. So a stock split can make shares more affordable for individual investors, expanding the pool of potential buyers. It attracts more number of retail investors. There's also the issue of perception. Perception. So companies may split their stocks to signal confidence in future growth, as a lower stock price might be perceived as a sign of accessibility and also opportunity. Number number five. Number five is should you do anything after a stock split? As an investor, should you do anything after the company, split its stocks? What are you expected to do? How are you expected to react? So in this case, no action is needed. You don't need to react. You simply remain neutral. The value of your investment remains unchanged after the stock split. However, the number of shares you own will increase, and the price per share, will decrease accordingly. So don't react to stock splits. Only react if there's a change, a critical change in the company's fundamental. That's when you should react. But because of the fact that the company undertakes to split its stock, that should not, move you into taking any action. It's important to note that stock split doesn't affect the company's fundamentals or market value. It doesn't really affect the company's fundamentals and does not affect the overall value of the company. Everything tends to remain the same. And so in conclusion, a stock split is a simple way to make shares more accessible without changing the total value of your investments. You observe that some companies are very high. Let's take, for instance, Amazon. The share price is very high. Consider Tesla is very high. So if maybe Amazon or Tesla undertake to split its stocks, maybe let's say maybe 10:1, splitting the stocks into 10 places. Assuming a company stock is $300 and the company undertake to split the stock 10:1, that means each share is going to be $30. 30 times 10 is still 300. So when it drops to $30, investors may be encouraged to pile in and buy at that, perceived low price. That's what stock split does, and it equally, increases the liquidity of the company. You can very easily sell, and you can very easily buy your shares, as the case may be.